You've heard of FOMO. Everyone has. The panic you feel when Bitcoin is up 40% in a week and you're sitting on the sidelines watching other people get rich. But there's a new fear quietly taking over, and it's doing way more damage. It's called FOLO, fear of losing out. Not fear of missing the next big thing, fear of losing what you already have. And right now, in 2025 and into 2026, FOLO is running the show. It's frozen more portfolios than any market crash ever did. Here's the thing nobody talks about. Both of these fears feel rational in the moment. That's exactly what makes them dangerous. FOMO, the fear you already know. FOMO has been around forever. But social media, 24-hour news, and AI-powered trading tools turned up the volume to 11. Every chart, every influencer, every "this is your last chance" alert, all engineered to make you feel like the train is leaving without you. And it works. Studies show FOMO-driven investors routinely buy at peak prices, right when the hype is loudest and the risk is highest. You buy in. The market corrects. The hype fades. And now you're holding something you bought for the wrong reason at exactly the wrong time. That's the FOMO trap. You don't make decisions. Fear makes them for you. The irony is that by the time most people react to a trend, the money has already been made. The smart money got in early and quiet. The noise you're hearing is usually the exit, not the entrance. Meet FOLO, the fear taking over in 2026. Now here's what's different. The emotional climate has shifted. After years of volatility, crypto booms and crashes, rate hikes, geopolitical chaos, investors aren't just afraid of missing out anymore. They're afraid of giving back what they already built. Daryl Trin, founder of Long Wealth Capital, put it simply, it's less about chasing gains and more about avoiding losses. And the data backs that up in a big way. Right now, money market funds in the United States hold $7.77 trillion. That's not a typo. $7.77 trillion sitting in cash equivalents, earning modest yields, going nowhere. That number just hit a new all-time record as of May 2026. People aren't fleeing the market because they think it's going to zero. They're fleeing because they can't stand the thought of watching their portfolio drop 10 or 20%, even temporarily. That's FOLO in action. Protection mode. Bunker mentality. And here's the part that stings. FOLO costs you just as much as FOMO does, just slower and quieter. When you park everything in cash and the market runs another 30%, you didn't avoid risk. You just traded one kind of loss for another. The psychology behind both fears. Let's get into the actual mechanics here, because this is where it gets really useful. FOMO and FOLO share the same root, loss aversion. The human brain, hardwired from thousands of years of survival thinking, feels a loss roughly twice as intensely as it feels an equivalent gain. Missing out feels like a loss. Losing what you have feels like a loss. The brain treats both as threats. The difference is in the direction. FOMO pushes you forward, into impulsive buys, over concentrated positions, chasing momentum. FOLO pulls you backward, into paralysis, excessive cash hoarding, selling too early, and sitting out rallies that were actually the exact moment to be invested. eToro research found that 61% of U.S. retail investors say their investment approach is driven by fear of losing money, compared to only 31% driven by fear of missing out. FOLO is already winning. And most investors don't even realize it's happening to them. Here's the tell. If you've checked your portfolio more than once today, if you felt a physical reaction the last time you saw a red number, if you've thought about moving to cash just until things calm down, that's FOLO talking, not logic. Fear. What happens when fear runs the show? This is the part that matters most. When emotion drives investment decisions, whether FOMO or FOLO, the outcomes are predictable, and they're not good. FOMO investors buy high, panic sell low, and repeat the cycle. FOLO investors miss entire bull markets hiding in money market funds that yield less than inflation after taxes. Swissquote's analysts put it well. We are entering a FOLO-dominant era, where the focus is no longer on finding the next opportunity, but on surviving long enough to hold what you already built. That sounds responsible, but taken too far, it's its own kind of destruction. Markets can absorb bad economic data. What they cannot absorb, and what destroys individual portfolios the most, is capital sitting on the sidelines indefinitely, waiting for a signal that never feels clear enough to act on. The $7.77 trillion sitting in money market funds right now is the most expensive proof of that. That capital is safe in the technical sense, but it's quietly losing ground to inflation every single day it sits there. How to build a portfolio that doesn't flinch. So what actually works? Not tips, not hot takes. Structure. The investors who consistently navigate both FOMO and FOLO have one thing in common. They made their decisions before the fear showed up. They built a system when they were calm, and then let the system run when the noise got loud. That means knowing your actual time horizon. 5 years? 20? The answer changes everything about how much short-term volatility should matter to you. It means diversification, not as a buzzword, but as a genuine psychological tool. When you're spread across asset classes, no single red number has the power to hijack your decision-making. It means scheduled reviews, not daily portfolio checks. Quarterly, semi-annual, structured moments to assess, not emotional real-time reactions to every market tick. And it means having a written plan for what you'll do when markets drop 20%, not what you'll feel, what you'll do. Because when it happens, you will not be thinking clearly. You need the version of yourself that made this plan when you were calm to be the one running the show. FOMO and FOLO are not character flaws. They're wiring. The goal isn't to eliminate them. It's to build a structure strong enough that they can't reach the controls. The bottom line is this. You are not immune to fear. Nobody is. The question is whether you've designed your financial life so that fear has no authority over your decisions. $7.77 trillion is sitting in cash right now. Much of it belongs to people who thought they were being smart. Some of them are going to watch the next leg of the market run without them, and then buy back in near the top, driven by FOMO. Same cycle, different fear, same result. Build the structure, stick to it, and let the people running on pure emotion be the ones who fund the next transfer of wealth, away from them and toward whoever stayed the course. Subscribe if this is the kind of content you want more of. Leave a comment. I want to know which one runs your decisions more right now, FOMO or FOLO. Be honest. The answer might surprise you. This is Potentia. See you next time.